Testing 1, 2, 3. Convince people some idiot that he is. I'm just going to start picking on all the other reports that you don't want. Well, this can be a big fight among the public. If the other one with the recording, the conflict is going to go back. Now, where? Okay. Can you hear me, guys? John, can you hear me? Hi, Angela, do you hear me?
Yes, I can hear you. You may want to ask everyone to make sure they mute their phones at the beginning.
What's going to happen?
Ask everybody to mute themselves.
Oh, okay.
Because otherwise they may be talking.
Oh, okay. We can mute them too. Hi, John. Can you hear me, John?
Yeah, I got you.
You've got two boxes for some reason. Oh, there it goes.
Okay.
You have another one, says John C. Well, that could be
Nothing,
again.
because.
Oh, I see. People are joining. Okay.
Okay.
People are joining.
John C. Jr. is my son.
Oh, okay.
I'm glad you can hear me.
Yeah, we can hear you.
Oh, good. He's in California. I'm in New York.
Oh, okay. Interesting. Okay, well, I'll probably want everybody to kind of mute themselves when we get started. Okay, we'll wait a few more minutes. Let people join us until lunchtime. Well, we should begin, I guess. How's everybody doing? Nice to have you all join us today. Other people will be joining. They can just add in as we go. We appreciate you being here. My name's Roy Schneider, and my associate here is John Balian, and we're with Schneider's and Associates. John is our tax lawyer, and I'm and our estate planning, and I do estate planning and corporate and business tax and matters like that. We're a full service law firm. You can certainly read about us on our website. We have 9 lawyers. We do everything from litigation to business startups, nonprofits, mergers and acquisitions, litigation, employment law. We cover the gamut for our clients and been around for a while. And so now we're going to talk about some of the tax changes, which may be of interest to you, or your parents, or other people. This is going to be recorded, so you could watch it again on our website, or ask your friends to watch it, or your family, and learn more. If any questions, just give us a call. We'll be glad to help you with your issues. This is kind of interesting and new, and we're all kind of floundering in this new environment. So we'll kind of see what happens together. I'm going to share my screen. Okay, so this will be our program. If you have questions, you certainly can put them in your chat, and we'll get to them when they're finished. We'll spend some time to do that. This program should last an hour, maybe a little bit more, depending on your questions. So, as you know, we had an election. I hope you all know that. There was an election, and it's just been completed today as we talk with the Electoral College. It's not all finalized yet because we still have 2 Senate seats open in Georgia, and much will depend who wins that, whether it's the Republicans stay in charge of the Senate or the Democrats. But regardless of who stays in charge, there may be changes coming down the pike. If the Democrats should win the Senate and they can make, and they want to move forward with some of these changes, the thing to keep in mind, we learned that from the last Trump Tax Act, that even if it's enacted sometime in 2021, any of these changes, they can be made retroactive to January of 2021. So let's not think that once we get past December 31, we're home free for any legislation. It could be retroactive. So, and the government's broke. We know that. The government is in serious financial trouble, and picking up money from dead people is usually the easiest thing to do because dead people don't vote. And so there may be some changes that we should talk about and be concerned about. Plus, we just passed an interesting Proposition 19 in California, and John knows all about that, and he might be interested about that. That has to do with passing along your current property tax to your children without increases. So that's interesting. So right now, we know for state tax purposes, the exemptions, basically escape 99% of the population of being worried about state taxes. It's $11,580,000. And next year's going to be $11,700,000 per person. So a couple can give $23,000, $24,000. Even if nothing changes, this legislation requires that the estate tax exemption amount goes back to $5 million, index for inflation in 2026. Index for inflation 2026, maybe it'll be $6.5 million. The expectation, at least the Biden's tax plan, calls for reducing the estate tax exemption to $3.5 million. And right now, interestingly, gift taxes is the same as estate taxes. So we have $11.58 million that you can leave people on death without a tax. You can also give that amount during your lifetime without a tax. One of the plans under consideration is to reduce that to $1 million. So the estate tax will kick in if you have more than $3.5 million or a couple $7 million, and gift tax will kick in if you give more than $1 million away during your lifetime, or $2 million as a couple. We'll wait to see, but those will be major changes, and that's why there may be cause for planning at the end of this year. So one of the things they're talking about is increasing the estate tax rate, and it's now 40%. So everything above $11.5, $5.8 million in your estate will be taxed at 40%. That number has gone across the board. Before the 2001 Tax Act, it was 55%. In the 1940s, it was 77%. So that is something that it changes all the time, from time to time. And the plan, and that's going to be considered, will increase the estate tax rate to 45% is what they're talking about. So it's kind of interesting. One of the other big benefits that we have had since really the 80s, maybe even earlier, is the step up in basis. You're all familiar with that concept. I'm assuming that if you have an asset in your estate and you pass away, your beneficiaries will get a step up in basis. So if you paid $100,000 for a piece of land, and when you die, it's now $1 million on your death, your heirs and your beneficiaries will take that property with a basis of $1 million. So if they sell it at $1 million, there is no capital gain tax. And under $1 million, there'd be no, and if that's basically the size of your estate, there'd be no estate tax. So it's a pretty good deal. One of the couple plans under consideration is something called a carryover basis, which means that if you bought property for $100,000 and when you pass away, it's worth $1 million, your beneficiaries will receive that property with a basis of $100,000 plus any improvements you've made, less any depreciation you may have taken, which means when they sell the property, there will be capital gains. That is one way to raise quite a bit of money. And the estate tax, by the way, when it was lower, it did raise billions of dollars for our treasury. So it is a way to generate some revenue. The other interesting plan is to trigger a capital gains tax on the death of the owner of the property. So if you bought property for $100,000 and when you pass away, it's worth $1 million on death, there could be a capital gains tax on the $900,000 gain that your estate will have to come up with, plus the estate tax. So you may end up paying both, which would leave little for your children or whoever the beneficiaries are. Now, who knows? That the carryover basis, that used to be the law years ago, they may come back with that, and that's a big deal. So that's one of the contemplated proposals. So no step up in basis, realization of capital gain on death, that's possible. Another interesting thing about capital gains rate, as you know, the rates now go from 0% if you're a single filer making under $40,000, then it goes to 10 to 20% if you're making like $441,000. And then it goes to 20%. It goes 10% for 440,000, and above that is 20%. So it goes from 0 to 20% capital gains rate. That's been that way for a while, has been rather appealing. One of the proposals is to impose a 39.6% capital gain rate on long-term capital gains for individuals with more than $1 million of annual income. So estate tax and capital gains taxes are used by Congress time and time again. And if you want to check it out over the last 20, 30, 40 years, it's changed a lot. And it's a way to raise money. So we'll have to keep our eyes on that. Another benefit that we've all had, the benefit of, or the advantages of for the last 40 years probably, was the like-kind exchanges. The Trump Tax Act had changed that. It used to be able to do like-kind exchanges even of artwork, but now it's essentially just real estate. But it would allow you to take a low basis property and instead of selling it and paying capital gains, you could transfer it. If you pick a like-kind property in 180 days, the money stays in escrow and you can just keep moving it along without paying the tax. And on death, the last property you own would have a step up in basis and your children or beneficiaries would pay no capital gains. That's how it's been. Congress has looked at the like-kind exchanges for a while. The IRS never really liked it. It is the law, it works. You got to be careful, you got to do it just right. But that's one of the things they may eliminate, the like-kind exchanges. Another benefit that taxpayers have used, a tax advantage plan, has been these valuation discounts. You may be somewhat familiar with those, but essentially how they work is if you own a business and you have 100% of that business, the entire value of that business is taxed in your estate because you have all the control. But if you're the parents, let's say, and you make gifts over years so that you end up with 40% of the business and your children's have 60%, that 40% is not really worth 40% of the value. Let's say the value is $1 million. That 40% is really not 400,000 because at 40% you don't have control, you have no marketability. By contracts, we can limit all those kind of rights that you would have, and therefore nobody would pay $400,000 for a minority interest in a company where they have no say. Maybe it's worth $250,000. these are manipulated, obviously. These are tax plans that people use. It's all kind of made up numbers, smoke and mirrors, but it's valuable. It's been used. Congress never liked it. Congress doesn't like it, and by and large. IRS doesn't like it. That may be in the chopping block. So we'll have to watch that. That's why you may want to consider plans before the end of this year. And gifting. And gifting, for example, the traditional policy with regard to gifting was you give high basis property to you beneficiaries now, so they don't have much capital gains and you can get it out of your estate. And you would keep the low basis properties in your estate until you passed away to get the step up in basis. So that may be changed. So some basic plans for help to minimize and eliminate estate tax. Some of these are tried and true, been around for a long, long time. Many of you are familiar with what we call the AB trust. Let's just take an example where you have a couple where they have money and it's a community property. They've been married a while, community property. So they set up this trust while they're alive. It has no particular tax benefits. It's not a separate taxpayer. It's just a probate avoidance, conservatorship avoidance kind of a document. But on death of the first spouse, the trust divides the assets into two separate trusts. There's a survivor's trust, which let's say is half of the community property. And then there's the B trust, what we call bypass or credit shelter trust, at different names, which the deceased spouse's half of the property goes into. The advantage of that is can be several. One, we do these without regard necessarily to the estate tax. It does protect children from prior marriages. Now that people have been married 2, 3, 4, 5 times, they've got kids from several different spouses, they want to make sure that the kids from their previous spouses are going to someday inherit their half of the estate. You do that by putting your half of the estate in the bypass trust, but if you pass away, the income goes to the survivor, but on the survivor's death, you're going to know that your assets in your bypass trust will go to your kids. Also, asset protection for your wife or your spouse, the husband or your kids, because the assets that are set forth in this bypass trust are free from the creditors of the spouse or the children until it's distributed. And there can be estate tax savings. We'll show that in a second. But it also can be, you can set these things up either at the time you create your trust or even after someone passes away to look at the situation at that time by using a disclaimer trust. And you can create it after death, so you can be very, very flexible. We try to make our trust as flexible as we can. And let me show you how this works. Let's say you have $20 million in your estate. Well, right now, if it's just, I give everything to my spouse, then on my spouse's death, $20 million, and there'll be a tax because you can only pass down $11.58 million. So the amount above that will be taxed at 40%. If you create this AB trust I talked about on the death of the first spouse, there's $10 million put in that bypass trust and $10 million stays in the survivor's trust. The amount in the bypass trust could grow to $50 million. It will not be taxed, okay, on the death of the spouse. It just can grow and grow and grow. So there's some strategy in putting appreciating assets in there versus cash in the survivor's trust. And then on the survivor's trust, we'll have the 10 million. And if that spouse passes away and the estate tax exemption is to 11.5 million, no tax, you've passed $20 million on to your beneficiaries with no tax. Now, if your estate is more than twice the annual exclusion, because you can only put into the bypass up to the 11.58 million. Next year, you can only put up to 11.7 million. If they reduce the estate tax exemption to 3.5 million, that's the most you can put in there. So if you have more than twice the amount, you have more than, let's say, right now, 23 million, or if it becomes 3.5 million, you got more than 7, you can even create a third trust called a Q-tip, a C trust. And the only benefit of that, on death of your spouse, it will be taxed to the surviving spouse, the estate tax, but allows the deceased spouse to control that. So if you truly want to make sure half of everything, and you've got $40 million, and we're going to make sure your half, your 20 million, because it goes to your kids from a previous marriage, you would then set up the C trust. You could have 11.58 million in the bypass trust, and the difference between that and 20 million in the survivors, in the Q-tip C trust. And this might be a much. You're going to be able to see these slides. If you want these slides, just let us know and we'll send them to you. But keep in mind that there is a way to protect protect your spouse and kids from creditors, to make sure your half property goes where you want, and to eliminate or reduce the estate tax by creating these sub-trusts. We have something now called portability, which is something fairly new. And what this allows you to do is get the estate tax savings, some of the estate tax savings benefits, without having to go through the expense and time of setting up a sub-trust. What it allows you to do is the first spouse who passes away can then port their exemption amount over to the surviving spouse. So in other words, if it's 11.58 million and you pass away, by the spouse, surviving spouse, by filing an estate tax return, checking off certain boxes, now gets your 11.58 million into his or her assets. Do what you want with, but that amount will avoid estate tax on her death. So she could actually have, he or she could have a 23.16 million, next year 23.4 million, or whatever the estate tax exemption will be. The surviving spouse just could have all that money, do what they want with it, because as this bypass trust, there's limits. The surviving spouse gets income, principal if he or she needs it for something, but isn't just there to deal with. Plus, any assets in the bypass trust will never get a step up in basis on death of the surviving spouse. So by having all the assets just in the surviving spouse's control and estate, that person gets to step up in basis on death, deals with the money without answering to anybody, deals with the assets, has no one to answer to, has no particular fiduciary duties to anyone. They're free to do what they want with those monies, and they have all the complete control. And on death, the entire amount in the surviving spouse's estate will get a step up in basis under the current law. The difficulty is it costs money, maybe less money than setting up the separate trust, but you got to do an estate tax return. And if the estate tax return is not timely filed, it's a day late, you'll lose that portability, which is now that's going to be a estate tax problem on the surviving spouse's death. And if the surviving spouse remarries, you lose this benefit. You lose the amount of the estate tax exemption from your deceased spouse. So you got to give some thought to whether that is a possibility. There is generation skipping tax, where if you skip a generation, you decide I'm going to just leave all this money to my grandchildren. There is a special generation skipping tax that can take effect, which is not affected by portability. You can't use portability. And it doesn't shelter depreciation. So again, if you have a bypass trust, whatever you have in that trust, it could appreciate to $50 million and there'll be no tax. If it's just ported over to the surviving spouse who has it all, yeah, all that appreciation will be in his or her estate. And there's no creditor protection. So these are kind of things you think about. On balance, the portability is a nice backup. Sometimes that's good enough to use, but much more planning can be accomplished by setting up these bypass trusts and even having the disclaimer provisions. So you can really be as flexible as possible. What you like, you can have the disclaimer trust, the AB trust, the portability, and the survivor can decide how best to deal with it. But these are important issues, and this can help reduce taxes. So how do you reduce your taxes? You want to reduce the size of your taxable estate. So right now you can use up your applicable exclusion amounts. We have clients that are actually making huge gifts now, making gifts in the multiple millions, because if they do change the gift tax exemption amount to 1 million, gifts over $1 million will be taxed. Now you can give 11.5 million without tax. So very wealthy clients are making those kinds of gifts now, even though the recipients of those gifts are getting the lower basis. Capital gains rates right now are a little bit lower, including state income tax with it, than the estate tax. So sometimes you're better off paying the capital gains than the 40% estate tax. So you can set up the gifts, you can use these or have these exclusions in your estate plan if they stay. And again, depending who wins the Senate, major gift plans, you should maybe consider gifts. So lifetime givings, again, I told 11.58, next year 11.7. If you make those gifts, it will probably be grandfathered in, I'm assuming. But you are allowed, and this will probably never change, to make a $15,000 a year gift per donee without using up any of your exclusion amounts, without filing gift tax returns. It's just not reported. 15,000. If you're a couple, you can give 30,000. If you've got 3 kids, that's 90,000 a year you can give away without any gift tax, without reducing your 11.58 million, without worrying about estate tax or gift tax, and without even filing returns. So gifts like that are very common. If you've got quite a bit of assets, you can make gifts to your children, to your grandchildren, 15,000 per year per person, 30,000 a year if you're a couple. That worked very well. And also consider if you have large estates, or your estate may not be that large today, but after the changes in the estate tax exemption amount, it may become large, is to consider gifts to tax exempt organizations. Sometimes you're faced with the choice of give this to Uncle Sam or give it to my favorite religious or charitable or educational institution. These are all the planning that we, and particularly John in our office with his tax background, will help you with those things. This is something, interesting that we've been seeing a little bit. The worst thing that happens to a family, a bad thing that happens to a family, is trust and will disputes. It is common, it happens. If the children, for example, are not treated all exactly the same, which sometimes they're not, there's going to be fights. And sometimes parents have legitimate reasons. They have a daughter that they bailed out for 30 years and they've given her hundreds of thousands of dollars over the years. They want to equalize things by giving the son a little bit more. There will be a lawsuit. That's just a whole nother presentation we have on family dynamics. So to prevent lawsuits, to try to make them less common, we sometimes put in our trust mediation arbitration provisions. We request that the parties mediate, and a mediation, obviously it's a third party who comes in and helps people decide. There's no judge. There's nobody who says you win, you lose. They help facilitate communications and they come up with solutions, and they do a very good job at that. And sometimes this aggrieved beneficiary just needs someone to listen to them, and it can be quite cathartic. So it's something to think about when you do that. And it's just less adversarial. Once one sibling sues another, they will never talk to each other again. Their relationship will be forever ruined. But not with mediation. You can still mediate, you can even arbitrate, and still remain on a good basis. So it's something to think about for those. And just a couple of advanced techniques. I've got this one, and I'm going to turn over to John. You might have life insurance. Maybe you have life insurance trust, but one of the simple, there are complex estate planning things we can do, very complex. But one of the most simple is this irrevocable life insurance. You set up this irrevocable trust, and you have the trust purchase life insurance on your life. Or if you have life insurance that you're thinking, maybe I'll get rid of, I don't need it, but you're concerned about maybe a future estate tax, you can transfer that to your irrevocable trust. But if you die within 3 years, it's going to be in your estate. But life insurance that's owned by this life insurance trust is not taxable in your estate. Normal life insurance is. You have life insurance, name your kids, the amount is part of your taxable estate, not in this irrevocable life insurance trust. And what it does, and you make gifts. You basically, the amount of the premiums is a gift each year. You give an amount every year that should be a little different than the actual premium, but the trustee makes the premium payments. And it was the famous Malcolm Forbes estate plan. You may know his son, Stephen Forbes, but Malcolm Forbes had an estate with $200 million. He purchased a $100 million life insurance policy and a life insurance trust. And when he passed away, the life insurance trust basically paid the estate tax, and his son got the whole $200 million. And actually, life insurance it's one of the best investments, not so much for the insured or the owner of the policy, but for the beneficiaries. The rate of return can be really very, very high. And maybe you can spend $100,000 and get $1 million life insurance policy paid for, depending on your age and your health. And you can even finance large, if you have a large estate, you can finance these things. So it is something to think about. And if the life insurance, let's say the estate tax exemption gets reduced to $3.5 million, and you might say, I no longer need this, right now, $11.5 million, you might say, I don't need this life insurance because I'm not going to have an estate tax. Well, if they lower the estate tax exemption to 3.5 million, well, maybe now you do need it. So I would think about these things before you decide just to get rid of your life insurance. But that is a tried and true, and we certainly can help you with that. So I'm now going to unshare. I'm going to get out of the share, and John, you're going to let you share the screen. And
Okay.
right, John, you'll be able to share it, and you can pick up here.
Okay, let's see if I can,
See if you can do it.
yeah. Okay, do you see my screen or not yet?
Says John has started sharing the screen, but I don't see the item.
How about now?
No. Can you see the PowerPoint? Click on that.
Let's see. Okay, let me try again.
There you go.
Okay.
There you got it.
All right, thank you, Roy. So picking up where Roy left off, one way to give something away but retain some rights to or income is to give it to a charity, but then retain some right to receive some money back. I'm getting a notice that my internet connection is unstable. Is it choppy?
No, it looks
No?
good
Okay.
here. It looks good.
So we set it for a number of years. So if you wanted to, let's say, give a rental property away for a number of years, the income away for a number of years to charity, we can set it up that way. If you wanted to leave the property or bank account or brokerage account, let's say investment, to a charity, we could have you retain the income from or fixed payments from that item, that asset, and then leave the remainder to the charity. What does this accomplish? It essentially allows you to receive the income, but also if it has appreciated in value, it allows you to spread the tax effect of that appreciation over an asset which you purchased a long time ago. If you sell it, you're going to incur capital gains tax at probably 30%. If instead you donate that asset to this charitable trust and have the charitable trust sell, is reported by the charitable trust, but being a charity, the trust is not taxed presently. Now, when the trust starts making payments to you, those payments will be part return of your original investment, part interest income, and part capital gains. So it allows you to spread this tax over a period of time rather than getting hit with it all in one shot. Okay. Now we can do something similar with your kids or other heirs. Give something away but retain some rights in it. If you try to do that with Internal Revenue Code created category, which you see the acronyms QPRT, GRAT, GRUT. So if you try to retain a right, it's dangerous. People have tried to come up with creative solutions where they've retained certain rights of usage to property. If they didn't fall within these three categories, and they thought they gave it away, they thought it's no longer their asset. Turns out the IRS takes the position asset at the time they passed away we're going to estate tax it to the tune of 40 to 55%, depending on what the law is in effect at that time. Go to the next slide. One of the most popular, I'd call advanced estate planning techniques, is using the QPRT. We call it QPERT, Qualified Personal Residence Trust. How does it work? Basically, we transfer your home into an irrevocable trust where you retain the right to live there for a number of that property passes, excuse me, at the expiration of that time period that kids trust. What does that accomplish? If you've given it away today, it's no longer your property. We report it as a gift, and any future appreciation in that property appreciates into the hands and ownership of your children. Here's an example. Let's say a home is worth $1 million. I put it into this irrevocable QPERT trust, but retain the right to live there for the next 30 years, let's say, because I anticipate I'm going to live beyond the 30-year period. If I 20 years. The whole key is in the QPERT, you need to outlive the time period that we put into the trust. We could make it as short as 5 years or 10 years, but why would we make it longer? We'd make it longer because the value of what you're giving away, if I've retained the right to live there for 30 years and it's $1 million property, chances are that that value that I've given away is probably only $400,000 worth, not $1 million for 30 years. And when we crunch the numbers, let's say it comes out to that I've retained 60% of the value by living there 30 years. If I decide that it's only going to be a retained right for 10 years, then the gift $750,000 worth of the residence and retained a $250,000 value for myself. So this is a way to break up the ownership and essentially give a gift on what we call a discounted basis. So you're not reporting it at 100 cents on the dollar, you're reporting a gift at something significantly less. Grantor retained annuity trust, we call it a GRAT. Again, this is a way to split the ownership over time. So this does not involve the principal residence. This involves other property. Usually it's a rental property or a brokerage account. And so again, we put it into an irrevocable trust for the benefit of children and retain certain rights for a fixed period of time. Either it will be an annuity, a fixed amount, or under a different form called a GRUT, basically we can, excuse me, a percentage of the value of the asset that we've given away. What are some disadvantages of this technique? Well, we've put the asset into the hands of this trust, we've given it away, and one of the basic gift tax rules is that whatever you purchased it for, which we call basis, transfers over into the hands of your children, essentially, who are the beneficiaries of this trust. So if they end up selling it, they will be the ones that will get hit with the capital gains rather than you, having been the previous owner. What's the advantage? You've given it away. It's no longer yours. It will not be taxed by the estate tax when you pass away, provided that you survive the period of time that you've said you've retained the right to income. So if, again, I use 10 years as an example, I drop a $1 million brokerage account into this GRAT. I reserve, let's say, $50,000 a year of annual income from this trust for myself. I haven't given a gift of $1 million. I've given a gift of something less. mathematically, again, we can crunch the numbers and say, okay, the retained right of $50,000 a year for 10 years shaves maybe, let's say, $300,000 worth of value, $1,000 gift rather than $1 million gift. What's the other advantage? If this stock goes up in value, it was worth $1 million when I gifted it to the trust, and it becomes 10 million 10 years later because, let's say, it was invested in growth and technology stocks. Well, that extra 9 million completely escapes the estate tax at my death because that appreciation happened to occur in the hands of the trust or the beneficiaries of that trust. So again, great way to get rid of stuff if you have a mindset of getting rid of stuff. That's the hard part, is convincing our clients or having them convince themselves that now is the time to start divesting of certain assets rather than having them, which the 40% is the lowest it's ever been. 55% is where it was for decades before 2001. And when Roy mentioned previously that one of the proposals out there is to have an asset be capital gains taxed, meaning income taxed at death, in addition to the estate tax, that's mind-boggling to me. Federal and state tax 30 to 33%. And so that would leave about 66% left over, 67% left over of whatever it was worth previously. And now that 67% gets hit by another, let's say 50%. We're now down to 33% of what it was originally. So a combined 67% horrifying tax. I can't imagine that they would do that, but the proposal is out there. Here's one of very timely topic. I think it's going to be written up more and more as this February 15th deadline kicks in. What is the February 15th deadline? Well, we've all enjoyed for decades the effects of Proposition 13. Back in 1970, sorts, led by a group that was led by Howard, managed to get on the ballot and passed by the taxpayers, by the electorate, Proposition 13, which essentially sort of froze your property tax to whatever it was in 1978 if you were an owner back then, or whatever time you purchased the property, that becomes your property tax base, your what we call your assessed value, your property tax, 2% per year, to run with inflation. So for example, if you bought your home back in the early 90s for $500,000, your property tax was based on the $500,000 value. Every year they added 2%. So the next year your home would be worth $510,000 for property tax computation purposes, and they would apply a 1.2% tax on that $510,000. The following year, it would go up another 2%, and so forth. So by now, your $500,000 property tax value home from 1990 will probably be valued at, say, $800,000 with the compounding of that 2% every year. Now, I don't know about you guys, but the last property tax bill I looked at had gone up by 9%. So how do we account for that extra 7% this year? Well, the county has the right to push through certain special assessments for school districts, fire districts, water districts, and the costs of which need to be passed down to the taxpayers. So 2% is the minimum, but you'll see a little bit more over time. So what aspects of Prop 13 did we enjoy? Well, you are up through February 15th able to leave your principal residence, no matter what its value, to your children at death, or even make a gift during your lifetime and have the benefit of your low property tax base carry over to your children. How does that work? Well, again, if we use the example of the home purchased in 1990 for $500,000, the property tax in 1990 would have been $6,000. Today, if that property tax assessed value is $800,000, today's property tax, or close to it. Now, if you gift that home to your children today, your children will, quote unquote, inherit, or they'll receive by transfer the benefit of your relatively low tax base of $800,000. Now, mind you, that home that was worth $500,000 in 1990 might be worth $2 million today. If your kids had to pay tax of 1.2% on $2 million, they'd be looking at a $24,000 tax, paying close to $10,000 versus the tax they'd be paying if they purchased the property, $24,000. Now, how does this new law, I'll describe in a few minutes how the new law affects that type of situation. But that's what we've been enjoying, or at least our kids have been enjoying as they inherit property. It doesn't matter what the home is worth. Worth $10 million have been purchased for, and the property tax that you're enjoying, the low tax, would carry over to the children. The other little quirk and loophole, if you will, in the tax property tax law that was is this ability to transfer not just the home's tax rate to your kids, but rather the tax rate of other real property. What does that mean? Other real property means rental property, residential rental, commercial rental, could be land, farmland, any other type of real property. The parent, each parent, can transfer up to $1 million of property tax assessed value to a child, again, through February 15th. This, as you'll see in the coming slides, will completely disappear as of February 16th, 2021. So we have a limited time to take advantage of this law, again, if you're of a mindset to transfer assets to your children. That will be the big hurdle. So again, what does this mean, assessed value? So for example, if I purchased rental property, a 4-unit building, again in 1990, worth $500,000. And today, because of that 2% increase, today my property tax is based upon an $800,000 assessed value. But the 4-unit building today is worth $2 million. If I make a gift today of this property to my children, they will enjoy the lower tax that I'm paying based on an $800,000 assessment rather than the current fair market value based assessment that they would pay if they purchased the property from a third party. The other benefit that exists alongside Prop 13 was Proposition 60. And again, this is in effect until February 15th. Proposition 60 allows you, if you're age 55 or older or permanently disabled, to sell your residence and buy another of equal or lesser value once in your lifetime within the county and over to the new home. Now, this was very rarely used because most people, if they're going to sell, they want to get something better, and that something better was worth more money. This was designed mainly to help people downsize. If there's, let's say they're selling their home and they're going to be buying a townhome or a condo as they retire for less maintenance and less headaches and more travel. And so now they're downsizing, they're going from a $1 million home, let's say, to a $500,000 townhome. Home had a $200,000 assessed value because they bought it 50. Value could be transferred to the condo, which is worth 500,000, and they would not have to pay tax based on the 500,000 purchase. They'd pay tax based on the 200,000 transferred value from their home to this condo. But I've never had a client actually be able to take advantage of this. I don't know if you have, Roy, but I have never been able to make use. Nobody downsized, the way that this law had envisioned. And so it's very rarely used. So the big benefit, as you'll see in the next few slides, as to why the electorate might have voted for this new law is because it makes this 55 or older property tax transfer much. Proposition 90, kind of a sister or brother proposition to Prop 58, essentially allowed you to move across counties. I'm going to pause for a minute because I'm running low on my battery. I will be right back. Angela, I don't know if you can hear me, or any one of the participants, if you let me know whether you can hear me.
I hear you. You're
I hear
good.
you.
Okay, thank you.
Mhm.
Okay, so sorry about
Hear
that.
you.
It was only a 30-second warning before it shut down. Okay, so what Prop 90 allowed is a lot of people were saying, well, I want to move out of county, transferring my property tax base within county doesn't work for me. So certain counties subscribe to this new Prop 90, newish, I guess it's still 20 years old. And so you were able, if the county you wanted to move to was part of this treaty, if you will, then you could move from LA to Orange or from LA to Ventura, LA to San Diego, and still make use of this property tax transfer. But again, the equal or lesser value became an impediment for most people.
John, your screen isn't, you're not sharing.
Oh, okay,
Let's
sorry.
Okay, let's get back to that.
How about now?
When you go on the share screen, you should see the slides as an option. There you go. You're on.
All right, thank you. Okay, so what did Prop 19 do, and why did the electorate opt for it? It was a slim majority, I think. The last for it, 15 million against it. So a slim margin of about 300,000 got it passed. And why do we think that it was passed? Is because what you read in the ballot mainly focused on this benefit, and it can be a significant benefit. So you got to be 55 or older under this new law. You can use it up to 3 times in your lifetime, and you can transfer your property tax base, that low tax that that you've been enjoying for 20 or 30 years. If you bought your home that long ago, you can transfer that to a home of equal or greater value. But what's the catch? That greater value, if you buy a home that's worth more, will be assessed based upon fair market value. So what does that mean? Again, let's use the $500,000 purchase, 1990. Today, it's worth $2 million. You buy a home worth $3 million. Okay. And now the advantage is you don't have to stay within county or find a county that is on the same. You can do this up and down the state. So you buy a home for $3 million. You got to do it within 2 years of the sale of your existing home. That extra above your current value will be taxed at fair market value. But the first $2 million of value will remain taxed based on your 500 per year annual adjustments, which let's say now is 800,000 property tax assessed value. So your property tax on the first 2 million, and then 1.2% on the next million over and above the 2 million current value of your home. So it's not a free-for-all, but it is a benefit. You don't have to stay in county anymore. And Angeles announced about the lack of enforcement on prosecuting trespass. They're not going to be prosecuting disturbing the peace or assaulting or resisting arrest, I should say, and a few other crimes, low-level crimes. They areas I suspect, and I'm already having clients telling me, we're selling out of LA, we're moving to Ventura, or we're moving to Orange. We're out of here. We're not going to put up with lawlessness. So there is a little bit of a panic already starting to happen in LA County. Previously. The bad part is that inherits your home or that receives a gift of your home, for them to benefit from this new law, at least partially, they have to make it their principal residence. So how does that work? Again, using the 1990 purchase as an example, you bought it for 500,000. Today, it's worth more. You gift the home to your kid, or the kid inherits the home. The property tax value on your assessed value on your property tax bill, whatever that is, plus $1 million. A little different than the one I've been talking about. The home is worth $2 million. It has a current tax assessed value of 500,000, and the child lives in the home when they receive it as a gift or as inheritance. The first 1.5 million will not change for property tax computational purpose. Will. So how does that play out? Essentially, the kid will be taxed 1.2% on the 500,000 that you're being taxed on. It's 2 million, and it exceeds the property tax value plus $1 million, which is 1.5. It exceeds the 1.5 by another 5, taxed at 1.2%. So essentially, the property it was in your hands, the property tax will now be 12,000 under this example when the property is in the hands of your kid. The problem with this, as I see it, is a lot of people have 2 kids, and so both kids are not going to be able to claim it as their principal residence. Only one's going to presumably live there, and so you're going to have to make a choice. Which kid gets the home, and and does another kid get another property to kind of equalize it? Well, the kid that gets the home benefits sort of from this $1 million exemption amount, but the other kid will not, as you'll see in the coming slides, because they're getting something other than the principal residence. So it kind of puts the parent in a difficult spot to make some choices. And in our experiences, when a parent has a difficult choice to make between children, they don't make a choice. What is the ugly part? So as I mentioned, beginning on February 16th, this law kicks in. And once it kicks in, even with this $1 million exemption, many children will experience a doubling or more. But what's worse is that the kids who inherit property that's substantially appreciated, because let's say it's in Beverly Hills or Santa Monica or Santa Barbara, Montecito, and this property, if this property was purchased in the 60s, 70s, or even the 80s, multi-fold increase in the property tax. This means even if the kid ends up renting the property out, chances are they won't be able to keep it. And that was part of the Board of Realtors in California spent about $35 million promoting this thing in commercials and public. Had an effect. Their property turns over, that it's not easy to keep it once it's inherited. And I think we will see over time, we will see the effect of that. So trying to make The example one is mom's Montecito principal residence, current value 10 million, assessed value 500,000, because let's say it was purchased in the 1960s. And in 1978, when it was worth, let's say 300,000, the 2% annual increases make it now an assessed value of 500,000. Property number two, mom's apartment building. Assessed value 1 million. So mom's total assessed values that she pays property tax on is 1.5 million. The original purchase price adjusted for inflation. Original purchase price plus 2% inflation adjustments, current value 500,000 for property tax purposes. So mom's paying about $18,750 in property tax. Mom now transfers property number one and property number two to child and claims the exemption under the current law. Child doesn't use the home as a principal residence. So under current law, after the child receives the transfer and reports that to the county that the child received a parent-to-child transfer and claims these exemptions, essentially the kid's property tax is going to be the same, $18,750 under present. Under new Prop 19, so let's say mom waits to make the gift 2021, the home, what's the assessed value plus $1 million. So 1.5 million out of the $10 million value is exempt. If the kid doesn't live in that property, it will be assessed at the $10 million. Same with the rental property. The rental property has new law, which goes into effect February 16th. So what is the effect of that? A 10-fold increase, and I'm not exaggerating. I mean, maybe the numbers are a little off the charts, but we are seeing this problem with properties in the areas I described: Beverly Hills, Santa Monica, Montecito, and coastal Santa Barbara will experience this 10-fold increase in property tax once ownership changes from parents to children. Ask ourselves, as homeowners and property owners before February, understanding of what your property is worth. Maybe if the property is not unique, if it's an attract development, if there are comparable sales, you might use as a starting point one of the online real estate websites. Look up, type in your address, see what they think your home might be worth. You might be surprised. And look at Zillow even has a trend line that shows you how rapidly it's been appreciating over the last 10 years. You can set it for a 10-year time frame and see what the trend has been. You might looking at the trend, you might try to project, okay, if it's gone up twice in value in the last 10 years, what will it be worth if that trend continues when I pass away? And life expectancy is about age 84. For women, it's probably age 87. So use those figures, unless your parents have longevity and they're living well into their 90s. We typically use the life expectancy statistics for our clients. Also, what do you think the kids will end up doing with the properties? If the kids are likely to say, thank you very much, Mom and Dad, I'm grateful but now that you've passed, I'm going to sell everything, then we don't need to worry about doing any planning, because what we're talking about here is the kid inheriting the home and wanting to benefit from your low property tax base, which property. If they sell the property, what we're talking about is this law particularly will affect people, maybe that beach home where the family has been gathering for decades during the holidays or in the summers, maybe that farm property that you want to hand down to the next generation. Those are the types of situations that will be dramatically and negatively affected by this law. Looking at your home, is it worth dollars over and above your current assessed value? So look at your property tax bill, look at the assessed 100,000, add $1 million to it because that's the exemption amount. How much above 1 million, that 1.8 million, it's worth substantially more. You may, and you think your kid's going to live in the property and not sell it, when you got some so almost towards the end, what kind of soul search clients my age? I still got another 30 years. I don't know if I can give something away, to them now. What if I need it? What if they get married to the wrong person? Is the property? Those are problems, that we got to consider. Can you part with this property permanently? Can you maintain some rights? Well, if you've given it away, but you've still retained the right to income or the right to live there, the county might say, yeah, with estate planning to eliminate, not work with this new, or like Roy said, we're scrambling to make sense of all this. We have some advanced planning concepts that will even be available beyond February 15th, but they're complicated. We're going to have to transfer properties to limited liability companies, family limited partnerships, start gifting slivers of those entities to the kids over time. It gets time consuming, costly, but it will be possible to do property tax transfer planning. It's just going to be a lot more complicated than it will be if you do this under current law, which expires February 15th. And that's my section, Roy.
All righty. Well, thank you, John. We did have technical difficulties, John. Your voice did cut out from time to time. So your internet was acting up a little bit. The slides were fine, but the voice was a little off. So apologize for that. If anybody has any questions, they can unmute themselves and ask us while you're here, or you can certainly in the chat room, or you can email us and let our office know if you'd like copies of the slides. But if anybody has any questions? Okay, well, if not, then we appreciate you being here. Just get in touch with us if you need anything from us, if you want copies, you want to discuss anything we've just talked about, let us know. Everybody have a great day and wonderful holidays, and we'll be in touch soon. Take care, everybody. Bye-bye.